Hello everyone, this is Avijit Chatterjee recording our weekly session of Charts are Fun for the week of March 3rd, recording this on Sunday, March 9th. We had almost a 9% pullback starting off from the peak on February 19th. S&P peaked at 6147 on February 19th. And in the next 12 trading days, we've pulled back to a low last Friday at 5666. A very interesting number, 5666. It happens to be right below the peak that we saw in July at 5669, from where S&P 500 pulled 9% from 5669 to 5169, almost a 500-point drop, a 9% drop in 14 trading days. Now it seems to be a 12 trading day pullback. I'll explain charts, interesting patterns, interesting repeating patterns where I feel we might be heading very close to a near-term bottom and an upside rebound coming. So look at the charts on S&P 500, then we will look at small caps, the Russell 2000 ETF IWM. And then TomLee was in podcast last week with Josh Brown. He's a CNBC columnist and also the CEO of Ritholtz Wealth Management. And he talked about his projection for Bitcoin towards 1.5 million. We'll explain the logic of how TomLee is arguing for that kind of an upside price on Bitcoin. So we look at Bitcoin's near-term chart. We look at the 2 hourly chart to see what that chart is telling us. We look at its weekly chart. And then associated with Bitcoin, we look at a couple of core stocks or Coinbase, which is one of the largest exchanges of Bitcoin, also the largest holding of Bitcoin. And in terms of all the various people who own their Bitcoin hold it with Coinbase and as a depository. And then we look at strategy or MicroStrategy, as the original name was. Michael Saylor has been in the news a lot. He's the co-founder of that company. We look at what strategy chart is telling us. So this is our start off with our website, our blog site, chartsarefun.substack.com. If you hit the archive, you'll see all the previous blogs. We publish it daily. If you just share your email, it's free. We will automatically get you the blogs every time in the morning. Right around 7 a.m. is when they get published, and you'll get a copy in your email box as soon as the blog gets published. Also, our YouTube site is also called Charts Are Fun. We do believe charts are fun, a lot of interesting patterns. Our goal is to make those reading of the patterns as fun and use it towards your investment decisions. We are not an investment management site or an investment management service, so we have no intent to provide investment advice. It's primarily education, trying to give you ideas and patterns on the chart, share with you, and help you guide your decisions, just like we guide our own investment decisions. Starting off with something that roiled the market last week. There is Atlanta Fed has their GDP projection. They kind of make forecasts of GDP called the GDPNow. It tends to be a numeric model, takes a lot of fast-moving microeconomic data, macroeconomic data all comes together to compute this. It took a sharp drop from right around little over 2 to 2.2% down to this is the expected GDP for the next quarter. It fell towards minus 2.8, a drastic drop. From there, it slightly came up towards that was on March 3rd. So opened the week with that GDP now forecast at minus 2.8 on March 3rd, as it says right here. Minus 2.8 on March 3rd. The next data point on March 6th, which was last Thursday, was at minus 2.4%. So it did come up a little bit. Unemployment number did creep up to 4.1, but non-farm payrolls was weaker than expected. Market was expecting 170,000 non-farm payrolls. For February, we got 151,000. It was a bit of a relief because earlier that week on Wednesday, when the ADP report came out, that was significantly lower than what the market was expecting. Market was expecting about 140,000 jobs to be added in the private payroll, and it turned out to be 77,000. So job market seems to be kind of weakening. Market is concerned. Market is thinking of the R word, recession in the in the near term horizon, and market participants are now looking at potentially tariffs causing a lot of uncertainty, a lot of hesitation on where we think prices could head. Some think that tariffs would cause inflation. Others worry that tariffs could cause uncertainty, and uncertainty could be investments kind of slowing down their buying decisions or investment decisions. And overall, it leads to a market related to recession, market prices bringing recession down into the economy. So that said, the New York Stock Exchange Summation Index is the advancers minus decliners, and it's a cumulative index. As I've shared multiple times in the past, it cycles from minus 1100 to plus 1100. In the last couple of years, we can see that it touched the 1100 area thrice around 2023, around February timeframe, then around late December in 2023 again, and then more recently around the late September, early October, it touched 1100. Since then, it pulled back in the last from that early October, late September towards early January. Over the 3 months, it pulled back from 1100 towards the minus 435. And then it has been climbing till the point of that last couple of weeks where we know the market had that correction. And in that correction from 266, it only fell to minus 41. That's indicating overall market breadth being fairly strong. Yes, S&P pulled back. A significant part of S&P drop are these mega cap Magnificent Seven stocks. They got hammered. They're all now down year over year, anywhere from 8% to Tesla being down over 30%. But Meta is the only strongest Magnificent Seven that's still holding positive for the year. But bad shakeout in those mega cap stocks. Netflix in particular got hugely hammered. It's not a Magnificent Seven stock, but it got hugely hammered last Friday. So that kind of large market cap stocks pulling back pulled S&P down quite a bit at about 9%. As I said, 6147 was the peak on February 19th and the bottom on March 7th. So we think it's the bottom, but what we got on March 7th was 5666, a 9%, 5666, a 9% pullback. So let's look at the S&P 500's daily chart to kind of understand why it looks very similar. On one hand, we can see that the peak from 5669 happened over 14 trading days. So as they say, market climbs an escalator and climbs up an escalator and comes down in an elevator. That's a classic elevator, very sharp drop in a very short period of time from 5669 to 5119. Right here about a 550 point drop. That 550 point was roughly 9%. Similar kind of 9% move from 6147 to 5666. Where is this 5666 number? Slightly above the 5669 number that we saw in the July peak, but kind of testing that level. And from here, we expect that perhaps we could start getting an upside move. Why? In the daily chart, we can see that RSI, as the market came to a lower low, did not print a lower low. It's hanging in there above the 35 level. So that's kind of a positive divergence. RSI not weakening as price came lower. Look at how oversold MACD is. Very similar oversold levels. Look at the black signal line to what we saw back in early August when the Japanese stock market crash happened on August 5th. Similar kind of oversold levels on MACD. RSI hanging in there, not weakening much. All and a classic test of the 200-day and closing right near the 200-day moving average, reversing with a nice reversal candle. When you see a long tail in the bottom, those are typically good indications of a reversal coming in the next several days. So that is a nice test, a sharp pullback of 9% to test the 200-day, which is rising, 200 moving average. Potentially, we expect a reversal higher. If you look at the hourly chart, that shows beautiful positive divergence or bullish positive divergence, as the technicians call it. Why is it bullish positive divergence? In the drop of the every candle here is an hour of trading in S&P 500. In this drop, we can notice that RSI only got higher lows. So much deeper oversold RSI level around the 24th. From the 24th, as we put successive lower lows in S&P 500, RSI kept getting higher lows. That's an indication of a bullish divergence. RSI not weakening as price comes to a lower low. Look at MACD. MACD also has a higher low from the previous low around the 4th and 5th of March. So this is an indication of a market bottom. And potentially we likely printed that bottom at 5666. Also a beautiful number, 666 right there. If you know, 2009 bottom was also 666. S&P was at 666. Amazing how market, because we know computers run amok in trading. Computers sometimes do these lovely mathematical magical numbers. So that 5666, to talk about the 2009 bottom at 666, lovely number 5666 is where we could have bottomed on Friday. Now I'm going to look at the small cap Russell 2000 ETF. This one is also got a very nice base from 204 on the bottom to the 156.99, call it 157 back to the 203. It's a nice base here. So 157 to 203, a base at the depth of the base is from 157 to 200 is 43 points plus 203, which is another 3 points, 46 points at 46 to 203, that's 249. Did we get that target? Not quite. We went to 244. But what we see here, this is our prediction, is a 5-wave Elliott wave move from 159 to 227 was the primary wave 1, then a wave 2 pullback from 227 to 195. Next wave 3 rally happened from 195 to 244. We now got an ABC correction. ABC from 244 to 213 was A, 213 to 230 was B, and from 230 to the recent low at 201 was the C. So that ABC correction setting up now for a 5-wave move higher to a higher high, which would form the primary wave 5 top. So we have 1, 2, 3, 4, and from 4 climbing to 5, likely headed towards the 260 level is where we are expecting the Russell 2000 IWM ETF to move. I talked about TomLee being on Compound. This is the show that Josh Brown said right here. He kind of does a weekly podcast. He invited TomLee as a guest. And in here, we show a chart from TomLee. It's in a Fundstrat. He's the chief investment officer of Fundstrat, where he talks about taking gold and taking the total amount of gold out there, multiplying it with its current price. This was done actually around November 2024, but it's around 2,800 is where gold has been hovering. At parity, as in the total market valuation of Bitcoin and gold being the same, would be around 950,000. Why? Right now, gold is at 10%. So if you just look at the parity on Bitcoin, not all cryptos, but just Bitcoin, it's about 2.1 trillion, and gold's total market cap is 21 trillion. So it's about 10%. Taking it towards 100% parity would take from 90, right now it's 80, it closed around 80, 85, not close, it was trading around 83 this Sunday afternoon, but from when this was done, it was around 95,000. So 10 times of that takes you to 950,000. However, he feels that if you give it a premium and gold price also goes up in the next few years from closer to 3,000 to 4,000, give it a 50% premium, this price projects to 2.1 million. So 1.5 would be just at a price of, at parity, it would be closer to 1.4, 1.5, but a 50% premium could give it a market price of 2.1 million. Well, that's a bullish forecast, but let's look at the near-term chart of Bitcoin. Here, we can see that this sharp pullback was the day when the strategic reserve got announced on Thursday. This is a 2-hourly chart. We can see that we bottomed at 78,000 not too far back last day of February. From there, we rebounded to 95,000, pulled back to 81, had gone up towards 91 when the strategic reserve got announced. What came out of the strategic reserve was not the US adding to their Bitcoin. They have about 200,000 that they've confiscated from various civil and criminal infringements. That 200,000 is what they'll hold for now in the strategic reserve for the longest of time. They don't plan to sell any of that Bitcoin. But market was expecting the announcement of buying of Bitcoin. They held back that. They said that if they do consider that, that would be budget neutral. They would think of creative ways to create the assets or the dollars needed to buy the Bitcoin without impacting the taxpayers whatsoever. They know that we are in fiscal austerity right now. We have significant, budget deficits. They have no intentions to add to that in buying Bitcoin. That said, market didn't like it. It pulled back from 91 towards 84,000, reversed higher within this 2-hour time period, went up to 91 again, and has been creeping lower over the weekend where we recently tested 82. Seems like we had headed to test that 81.4. The RSI is deeply oversold at a lower low, so there's no positive divergence here with respect to, you're at above the 81.4, but RSI is at a weaker, and MACD is also declining. This looks like a potential test of that 78,000 is likely. And worst case, where we climbed from Bitcoin at 51.5 was the 2022 November low. That is wave one climb from there to 73.8. Wave two pullback was from 73.8 to 49.2. From 49.2, we went to 109.2. That's 60,000 wave three climb. The wave one climb was from 15.5 to 73.8. That's roughly, 58.3 thousand, 58,300 is the wave one climb, 58,300. Wave three climb, which the next primary impulsive wave climb was 60,000. We pulled back to 78. There is a possibility that this could pull back and retest that 73.8 level, but or worst case, just best case, just maybe retest the 78 again. But that upside move, if wave 5 is anywhere like the wave 3, which is 60,000, 78 plus 60,000 takes us to 138,000. If it's 58,000, then 58 plus 78 is 136. So 136 to 138 is potentially where we think this, just mapping either a wave 1 or wave 3 in the length. Potentially it could be being an impulsive wave, even a slightly overshoot and maybe go towards the 140, 150,000 possible. But that's where we see the wave 5 is yet to come, and hence this pullback that we're seeing over this weekend into early next week could be a buying opportunity, is what we strongly believe. Similar patterns is seen in Coinbase. This is as I said, one of the largest crypto exchanges. We can see that from a low at 31 in late 2022, it climbed to 283. That's its wave one climb. Wave two drop from 283 was towards 146. Then wave three climb came from 146 to 349. A pullback towards a recent low. That recent low was around 193. And we can see that the climbing channel, in a similar way to Bitcoin's channel right here, Bitcoin was, you see the upper end of the channel test, pull back to the lower end of the channel. Similar way, Coinbase tested the upper end of the channel, pull back to the lower end of the channel at the higher low. And we expect it to climb back as wave 5 is yet to come. Finally, MicroStrategy, or as they call it, strategy, unlike coin or Bitcoin, which have a kind of linear climb, this had a parabolic climb. Look at where its wave one was from a low around 2000, late 22, around 15 or 613. It went up to 200, around number 200. That was the completion of wave one. Pull back towards 101. So almost a 50% cut, 49% cut on there towards a 101 wave two. From wave two, it had a parabolic climb from 101 to 543. That was almost a 5 multiple, over a 5 multiple, 5.4 multiple. Got it to wave three. From wave three, 543 got cut more than half towards the 231, 231.92, 232 level. The wave 5 on this is yet to climb. Being parabolic in nature, because they do more of, as they go about kind of risking their portfolio, there's more leverage, and being more leveraged, their movements are significantly more than what the Bitcoin spot price movement is. So if we get another parabolic climb, this could overshoot towards 1,000. There's a possibility that strategy could perhaps peak at 1,000 when Bitcoin reaches its 150,000, or anywhere from 136 to 140, 150,000 is where MicroStrategy. I'm not saying to buy MicroStrategy, extremely risky stock, but that's what Michael Saylor is trying to pump the stock to. And potentially this could have a very parabolic fifth wave climb coming in the next couple of months. We feel that If we look at S&P 500, we look at this pullback. From this pullback, how it's kept climbing higher highs, we expect this to now cross 6147 and start climbing higher highs. If you look at its weekly chart uh, in the S&P 500, I think it's right here. We went somewhere around S&P, the monthly ascending. Actually, this is a very long-term chart from 2009, and we can see that it has been climbing along this beautiful channel, hasn't broken down below it, even when in the COVID times, it pulled the low end of the channel at 2191, went and touched the top at 4818 in the late 2021, 2022. Since then, it's been hovering in the middle to the top section of the channel. It has yet to climb towards the top end of the channel, which is moves over 6,500 is where we think it's headed. But if you look at the S&P's weekly ascending channel, this is also the beautiful five-wave move from 3491 to 4607, wave 1 to a 4103, wave 2, wave 3 climb from there to 5669 to a 5119, that 9% move as wave 4. That wave 5 has got 5 subwaves. We've had first, second, third, fourth subwave. Turns out that because this fourth subwave went below the second subwave here, many ways you could say that this is an ABC, and we might just be completing the the second subwave for us to start climbing further higher. This was a bit of a concern of the negative divergence that led us to the pullback. We can see that as S&P was climbing along the channel, RSI was printing higher, lower highs, and that was kind of what led us. But if the RSI doesn't break down here towards 30 or lower and maintains around the mid 40s, 45, 46, and reclaims its climb, we expect that upper end of the channel to be tested, is where we think S&P is headed. With that, good luck investing. It'll be a very interesting week next week. If the hourly chart is giving us any indication of this bullish divergence, we think a bottom is in place as of last Friday. We are bullish on S&P. We're bullish on small caps. We think it'll climb back higher highs in the next couple of months. And we are also bullish on Bitcoin, more from looking at its five-wave move. The fifth wave is yet to climb. We expect it to climb above 109,000 and head closer towards 136 and higher in the next couple of months. Good luck investing. Thank you.